Hey guys, today we'll be looking at an exam question from your December 24 FM paper. Let's look at this problem. A project requires an initial investment of 5 lakhs in creating a fixed facility and ensures a net incremental inflow of rupees 1,50,000 per annum before deduction of depreciation and tax. This is likely to have an economic life of 5 years with a scrap value of 1 lakh at the end. Depreciation is allowed on a straight line basis. The tax rate is 40% and the cost of capital is 10%. You are required to estimate the IRR and advise the management on its acceptability. You are also given the PV table at 10, 11 and 12%. How do we solve such problems? All NPV and IRR problems are quick wins. All you need to do is understand the cash flows, the inputs, and calculate the present value. The step 1 to solve all of these problems is to draw a timeline of cash flows so that you understand what happens in which year. That's the only step where you will make a mistake. If you know which cash flow happens in which year, you discount them correctly and you get the final answer. Your initial investment of 5 lakh happens in year 0. That's the first row. This project results in an incremental cash flow of 1,50,000 per year. That's the next row. Now, because you have a machinery, you also need to depreciate it every year. To calculate the profit, you need to subtract depreciation just like you draw or write any income statement. So your depreciation is your initial cost minus your salvage value by the number of years, because this is a straight line depreciation method. So in this case it's 5 lakh minus 1 lakh by 5, which is 80,000 per year. This gives you a pre-tax profit of 1,50,000 minus 80,000, which is 70,000 per year. Your tax rate is 40%, so you calculate your post-tax profit to be 42,000 every year. The most important step which people forget is to add back any non-cash expense. In this case, since your non-cash expense is depreciation, you add back 80,000 to your post-tax profit. This comes to 1,22,000 every year. The last step is you also get back the salvage value of your machinery, which is 1 lakh at the last year. So this gives you 1,22,000 of profit plus your 1 lakh of salvage value, which is 2,22,000 in the final year. So these are your net cash flows in year 0, 1, 2, 3, 4, 5. Now all that is left to do is to calculate the present values. You are given the cost of capital of 10%. You are given the PV table numbers of 0.909, 826, 751, 683 and 621. Calculate the present value using these PV tables and you get a positive value of 24,480. Since this is a positive number, you accept the project. The problem goes on to ask you to calculate IRR. Now how do we calculate IRR? You have two other cost of capitals in this problem, 11 and 12%. Now let's do a trial and error and see what's the IRR at which NPV becomes 0. That's the definition of an NPV. If you calculate NPV at 11% using the same table, you get 10,200. If you calculate NPV at 12% using the same cash flows and this numbers, you get minus 3,400. So now you know your IRR is somewhere in between 11 and 12%. That's the number at which this will become 0. Substituting in the formula for IRR, IRR is R1, which is 11%, plus R2 minus R1, which is 12% minus 11%, which is 1%, multiplied by a ratio. What's that ratio? It's the ratio of your NPV by your difference in NPVs. So your NPV1 is 10,200, your difference in NPVs is 10,200 minus 3,500. This gives you a number of 11.75%. Now let's compare the decision rule. For the decision rule, you compare you compare IRR against your cost of capital. Your cost of capital is 10%, your IRR is 11.75. Since this is greater, you accept the project. The way to verify whether your answer is right or wrong, check if both NPV and IRR give you the same decision. In this case it does, and that's how you solve this problem. Stay tuned to our channel for more such exam oriented videos which will make you clear your exam in flying colors. Thank you.